You guys still there?
Yep.
Oh, I guess my computer just restarted. All right, so sorry about that, guys. So basically, I'm going to get into an overview of smart money concepts today, and I guess the grassroots of it all is if you take somebody's trade idea, do your own analysis on it, right? Hit them up, ask them, him or her, what they're seeing, and they will probably be okay with it, explaining to you why they're taking the trade idea, right? And understand that trade ideas are trade ideas. They don't always work out, right? But the goal is to have everybody understand why they're taking the trade and understand what they're looking at when they look at charts, okay? So smart money concepts. There are a lot of YouTube videos that will give you the basics of smart money concepts, right? What are smart money concepts? I get that a lot. I see that a lot in the chat. So smart money concepts are things like imbalances, right? They're order blocks. They're Wyckoff. They're the composite man theory. All those things we utilize as traders to, I guess, do predictive analysis, right? Can you be successful if you're only a technical analysis type trader? Yeah, technically you can still be successful, right? But you want to get to a place where you can combine the fundamentals with the chart, right? The fundamentals are the reasons why pairs or prices are doing what they're doing, right? And the technicals will tell you exactly what the chart is set up to do, right? So anytime that there is unrest or fear, the stock market, I know we use the VIX, volatility index, and the higher that number, the more volatile the stock market. I know it used to be, and Sean, you can correct me if I'm wrong, when the volatility is high on the VIX, those markets used to sell off, right? I don't really follow the indices, as much as some other people, but I think it's the higher the VIX, the more likely the market is to sell off. Is that right, Sean? You're on mute if you're answering. Can't hear you.
Hi, sorry I'm late.
Sean.
Ty, you're on mute.
Okay. All right. Yeah. Basically, what you said is correct. For everybody's edification, he muted me and then was telling me I'm muted. So, but yeah, the higher the VIX, then the greater the fear, and you're more likely for a sell-off in the general stock market.
Okay, so if you understand those, there are certain little nuances about the market. If you understand, you can make money, right? It's kind of like if you understand the relationship between interest rates and currency, you can make money. Anytime a country raises their interest rates, generally speaking, that currency is going to get stronger. So if you match that currency up with a country's currency that has a weaker interest rate, you should know which one is buying and which one is selling based off the interest rates, if all other things are the same, right? So if you know these things, then you can understand how the fundamentals drive the market, okay? So You guys know we raised interest rates in America. I guess earlier or just this past month, when we raised interest rates, the indices will sell off. They had been selling off since January in anticipation of the interest rates raising, right? And we should do that every quarter. We should raise the interest rates. That's the expectation, at least. We'll see how it goes. They can't just continue to raise interest rates with no adverse reactions, right? If you raise the interest rate, it tends to cool off the economy because people stop spending money. The economy requires people to spend money in order to keep it going, okay? But if you don't raise the interest rates, then inflation, goes through the roof. And next thing you know, you're paying $30 for a pack of chicken wings, right? And you're paying $8 a gallon for gas. So a lot of things feed into prices, and a lot of things feed into the way the market moves. And if you have a general understanding of economics, then you'll be a better trader, okay? So at some point, you probably want to pick up a economics book, or just take you an economics class. Take it on YouTube free of charge, right? YouTube is the greatest university on earth right now. So let's talk about some smart money concepts. I did a lot of studying with ICT and a lot of his spinoffs, right? There are a lot of guys that learned from ICT. ICT can be a little bit dry, but he gives a lot of information that is of great benefit. Okay, I don't want to play these videos, but if you want some YouTube material to look at, I recommend ICT's Market Maker series. All right, I recommend his WENT series, What Every New Trader Needs, right? Those two series in particular will probably set you up to become a better trader. Now, you're going to have to learn some basics. You need to understand that there's a cycle, a price cycle. The prices go through these cycles. A lot of things are cyclical. We know as regular consumers that gas raises in the summertime and it cools off around Christmas or whatever. We know that orange juice futures, get more expensive in the wintertime. All these things, they run in cycles. And a lot of time the currencies run in those cycles. A lot of times you'll hear people refer to the euro and the Great British pound and all these other currencies in terms other than what they're called, like cable and stuff like that. So copper or oil, for Canadian dollar, right? Canadian dollar will be affected by the price of crude oil. All these things you can pick up, as you start moving through this material, and it's going to help you turn that knowledge into a little money on the side, okay? All right, the Market Maker series was one series, and the WENT series, W-E-N-T. If you type in ICT WENT series, it's What Every New Trader Needs. Those two series will be, a mouthful, right? The guy is he's long-winded and a little arrogant and dry to some folks. So, don't think you have to listen to every single word. There are going to be some things that he talks to that's a little bit over your head, but you'll find that as you start learning, you'll recall some of the things you hit, some of the things that you hear. So I would start with the WENT series, then I would go to the Market Maker series. I think that's a better order. And if you guys want more, if you've already watched those series, get with Dez, because Dez is somehow confiscated like his everything. Okay. But let's talk about order blocks and imbalances, because everything that I do in the market, it really starts with with order blocks, right? When I first started trading with Ruby, all that she talked about was support and resistance, right? You know, I'm at the point now where I don't really notice that type of stuff. Okay, so I don't knock it, you know, because I learned via that method. You know, it just the inconsistency was it was a lot, right? So any of these videos, you know, easy order blocks for dummies. Trax FX has one. This is Psych FX you see right here. Savannah, this girl, Smart Money Academy right here. Order blocks in 3 minutes. She teaches a different style of order blocks, but it's fine. She's a good trader. I think that's one of Dez's favorite chicks. This chick right here, I mean, this guy right here, Track FX. He trades order blocks more in line with the way I do it. There are a number of ways to trade order blocks. So, you know, I don't want you to think that that anybody's one way is the best way, right? It's kind of like there are a number of ways to use Fibonacci's and trend lines, and there's a number of ways to use any of the tools, indicators, moving averages. So I use order blocks in a very basic manner, right? I took what I knew and I pared it down to where I thought was the simplest process to teach a brand new person how to trade order blocks successfully, right? And you know, because I'm a swing trader, the trades take a little longer, all right? But we use the higher time frames. Generally speaking, the higher time frames have less interruptions, you know, less noise in the lower time frames. Okay, so the way it's been working in this war environment is if I get into the trade, you know, at 6 p.m. after 6 p.m. East Coast time, if I get into that trade after 6, when I wake up in the morning, I'm in profit generally, right? And I can move my stop loss up to protect the profit, or I can at least move it up to where it will break even if the trade reverses on me. Okay. I got into swing trading because you know, I had a job and all that good stuff, right? I wanted to live life and still get paid. There are a lot of people who feel like you can't make a lot of money swing trading, and I would tell you that that is a lie, right? They also say you need a large sum of money in order to swing trade, and that's a lie, you know? So I am a supporter of prop firms, right? You can take 84 bucks, get a $10,000 account, and you can trade and make all kinds of money with that account, right? You can spend $99 and get a $2,000 account. You can still swing with that account. So don't let people poison you when it comes to, to different styles of trading. Okay, any style of trading will pay you more than whatever job you have now. I don't care what type of job it is, right? Once you learn how to do it, you know, over a 12-month period, you'll make more trading than you will working, right? Once you learn how to trade. So that's the truth and the skinny of it. Okay, you can go back and forth with people all day, but the proof is in the pudding. So we talked about order blocks. Okay, imbalances, right? Imbalances are another thing that we need to learn as we learn about smart money concepts. Okay, going forward, because of the amount of people, I think we're going to have to break these classes up. I don't want to like take everybody back to the beginning. So going forward, we're either going to have a second class on Saturday, or we'll just have a class on Sunday for these basic things. Okay. Everybody who has an understanding, we'll just have a, we'll pick up where we left off. But I have to make an exception today because we had a number of new folks. But so imbalances is another thing we need to understand. Imbalances, same thing. You can type in imbalances, and there are a number of people who will be able to give you a decent explanation of imbalances. Okay. All an imbalance is, if you look at a chart, right, is when the market expands rapidly. In fact, I'm just going to show you on a chart. All right, can everybody see my screen? Just type 1 in the chat if you can see it. All right, got it. So we're going to look at at this down move right here on gold, right? So healthy price action that does not leave an imbalance. When you look at 3 candles, this green candle, this red candle, and this red candle, you want to see the wick of this green candle. You want to see the body of this red candle. And when this third red candle starts, it needs to have a wick. This wick needs to come up to the bottom of this wick right here, right? That would be healthy price action. Then the market can fall and we're good to go. You guys can see in this case, that did not happen. I can draw a box from the bottom wick of this green candle to the top wick of this red candle, and I understand that this area is an imbalance, which means the market needs to come back up and fill this imbalance. All right. There are a number of ways that people look at imbalances. When I learned imbalances, my understanding is that once price mitigates halfway, that this imbalance is considered closed. Okay. It's really neither here nor there with the way I trade, but you just need to understand that those imbalances exist, right? And price will go back to imbalances, Yeah, Gigi, you should be able to see my screen. Much the same way that price goes to any form of liquidity. If you cannot see the screen, type 2 in the chat, please. Everybody should be able to see. Hey, Gigi, try to like come out, go out of Zoom and come back in.
I can see it now. Thanks.
Okay. All right. So let's look at the next 2 candles, right? So this red candle has no wick, which means that the third candle needs to come all the way up here to fill this imbalance. And it doesn't. It leaves this area of imbalance, right? And then you get to this last one. There's another imbalance that's left. So when the market expands rapidly, you'll find a lot of unhealthy price action or a lot of imbalances, right? So there's 3 levels of imbalance left right here. And what we want to see as traders is the market trade back up to mitigate these imbalances. And you can see this impulse move, this first pullback, they mitigate this imbalance, right? So if you take this imbalance and run it across, that imbalance is closed, right? Market comes up and then the impulse moves to the downside, which leaves these two areas that still need to be mitigated, right? So once price comes back up, where do you think price is going to go to? The liquidity is, at these imbalances and then at the top of the market. So understanding why price is doing what it's doing, the fundamental behind the price, and then understanding where it may move to next are two key components in trading, right? Price is always going to move towards the money. And in this case, the money, is in the form of these imbalances and the liquidity that sits at these highs, right? If you don't understand liquidity, you need to watch videos on liquidity, right? All liquidity means is where people have their stops, whether they're buy stops, sell stops, or stop losses, right? That's where the market will move to all this money because they want to take the money that rests at these levels, okay? So order blocks, imbalances, those are crucial pieces or key pieces to smart money concepts, all right? Let's talk about Wyckoff, right? And the composite man, okay? If you're a parent and you have kids, whether you have kids at this point or you're just a child of your parents, if you think about it, there's been some time in your life when you've manipulated your child. I don't, whether it was to eat vegetables or, you wanted to get them to do something that they really didn't want to do, get dressed for school, for church, or what have you, right? So you either told them a story or you coerced them in some manner to get them to do what you wanted to do. The market and the market makers are no different, all right? They're gonna coerce you into doing things with your money through your psychology in order to make you give them a better price, right? So the market makers wanted to take gold lower. They don't just take gold lower, right? They wick it up. They take it higher first. And what does this higher move do? It runs through your stop loss. Maybe it makes you feel like, hey man, gold is going up. I thought it was going down. So you start changing your bias. And as soon as you get, your buys in or whatever, they drop the market very fast. And there goes your money and your psyche, right? So it's the same, right? If you understand that about trades, right? Most trades goes one way first before it goes the other way. If you look at these wicks, that's why you have these wicks on the candle. Very rarely does price open and fall. Like there's no wick on this candle. It just opened, right? This price went up, came back down. This candle opened and the price fell rapidly. Most of the time, price is going to open, go the opposite direction, then fall, right? Fell way down here, came up here. Open with the opposite direction, fell, retrace, open, opposite direction, fell. You're going to see this in price because, the market maker has to make a little money. This is how you shake people out of their positions. In a lot of the mentors out there will talk about the composite man, right? The composite man. So there's a guy out there, Richard Wyckoff, that came up with these concepts way back in the day, right? You can Google old Rich and his trading methods, okay? I'm not saying that you need to understand everything about Wyckoff, but I'm telling you, if you can recognize Wyckoff, you can make yourself a nice little bag, right? There was a time where I was in Ruby's class and a lot of people, or I still see it, y'all. A lot of people will say, the market is consolidating. And most of the time, whenever you see consolidation, it's Wyckoff playing out on some level, right? The market doesn't just go back and forth for no reason. The market consolidates, right? I mean, the market either distributes or it accumulates, right? And most people call that distribution or accumulation. They call it consolidation. So if you look at this price cycle, right, and ICT has the same sort of price cycle, but Lord forbid he ever hears me say that, because he's very particular about his price cycle. You have the accumulation, right? Then you have the markup, the price distributes, and then it marks down, okay? So you'll hear a lot of people talk about supply and demand. You'll hear a lot of people talk about support and resistance, whatever the hell you want to call it. I'm not here to bust grapes and see who has the biggest straw or whatever about the terminology, right? I just want you to understand what's going on, right? So price is cheap down here, right? So it accumulates, right? This is the area, if you can imagine a candle, where price will push down, right? The market maker already knows that price is going to push up, but they want to push the price down because they want to buy it, right? While it's pushing down, they understand that if they buy it low, they can sell it once it gets high. So you could be in a position where you're holding it right now and it pushes down. And instead of you holding it, waiting for it to go up, you'll get out of it, right? And you'll start selling it, and then they'll buy it. That's called the composite man. They're taking the money from the weak hands and putting it to the strong hands by pushing this price down, right? It's never really going to go far. It's just going to push down to make you think that you need to get out of it. You need to get out of your buy, right? And when you get out of your buy, they pick up your buy and they take it and they make money with it, right? Same here. Price gets to about this range, it's at its highest point, right? And you might know that and say, oh man, price is going to sell here. Well, guess what? They're going to push it up higher, scare you out of your sale. You might start buying it, and then whoop, they drop the price, and it's a vicious cycle. This goes on over and over and over. This is called the composite man. And if you want to read up on old Richie Wyckoff, go ahead and do that. But I just want you guys to maybe get yourselves the schematics, right? Print these out, put them by your, oh man, how come I can't find this crap?
Todd, there's a PDF that I put in the group a long time ago because he has 16 Wyckoff schematics.
Right.
So they're there.
Well, just tell the new people where they can find them.
Okay.
So get with Des. I don't know why, my computer restart is being crazy, but there are some schematics. Really, there are 4 major schematics that you can print out. You don't need to know how to label it, right? You don't have to label or be able to say, hey man, this is a automatic rally, or this is the up thrust, or this is the up thrust after distribution. It's nothing wrong with trading like that. If you want to be a Wyckoff trader, right? If you want to be a Wyckoff trader, that's fine. I don't discourage that, right? But what I'm telling you is you don't have to know what all this means. You don't have to know what a spring means. You don't have to know what the last point of support is. You don't have to know that. But it's important that you understand that this is a Wyckoff schematic playing out and that price is going to go up, right? When you look at this, you can say, hey, man, the market is accumulating. Instead of you saying, hey, man, the market is consolidating, it's in consolidation. I'm waiting for it to break low before it goes high. Just understand that this is Wyckoff playing out, right? And you have a bias that price is either going up or down because it's either accumulating or is distributing, right? The accumulation means price is going to go up, and the distribution means price is going to go down. And the way you recognize this is in an accumulation schematic, the lows are being manipulated, right? So the price, this is actually the low of the market. The rest, all this stuff right here is the composite man scaring you, taking your money, right? Getting you out of your buy positions by taking out the lows, right? Making you think, hey man, the market is going to go lower because it's inching lower and lower. And then they shoot the market up, destroying your confidence and your little money, okay? So you have order blocks, you have imbalances, you have Wyckoff. Those to me are the grassroots basics that if you have an understanding of those, you can go into the market and you can find a level of success, right? I'm not saying that that's all you'll ever need to know, right? I mean, it is all you ever need to know in order to make money. But if you want to understand the market a little deeper, I would suggest that you start there, and then you can kind of take your studies and it will lead you in a certain direction. I will teach you, how I use order blocks and imbalances to a lesser degree in the way I trade. Okay. I will also help you come up with or help you understand my personal concepts, the way I trade and my personal strategy along with that concept. Okay. I'm not saying that that's the be all end all. It's not. And I know you can trade on lower time frames, but I can only show you what I find successful. Brianna is for those of you who know Bree, she's going to give you basically a spinoff of what I do on a lower time frame, and it's very successful. And it will allow you to trade, I believe, the 15-minute time frame. So if you have an appetite to trade faster, you can do it on a lower time frame. I just want you to understand going into it that the higher time frames is less noise, right? So that means your order blocks will be respected better on a higher time frame. Okay, it's harder to be fooled when you start trading on the higher time frames. Do I have any questions so far? Okay, so let's frame a pair real quick. Okay. I know that you guys who are coming from Ruby's class, you guys are used to the weekly analysis. I'm just going to show you very quickly. I don't even know why I'm using gold because I don't really trade gold, but I'm going to show you what I do to frame a chart. And what I mean by frame is I'm a firm believer that if I know where my order blocks are and then I have a direction and a point of interest that I can target, you know, in the market. So I go to the monthly time frame. I'm going to find my order block. I'm going to mark it up, right? The order blocks that I use, you have the small red candle, this big green candle, that's a bullish order block, right? I'm going to find the one that's directly below where my price is on the monthly. And I'm going to find the one that's higher. In this case, you know, gold is at a damn near the all-time high. So just for S and Gs, I'm going to mark the top of my market right here. You can label this with a call out box. You can label it with a text box, however you want to do it. Okay. I'm not going to label it. Then I drop down to the weekly chart, right? And I want to do the same thing with my weekly chart. Order block. All right. Price hasn't violated and or invalidated the order block. When I say invalidate, I mean there's no price that goes lower than the wick on this red candle, right? If as long as the price does not invalidate this order block, it's still good to go. So where is my highest order block, right? Here's price. Here's a bearish order block. You see the smaller green body with the red candle that breaks structure to the bottom side. That's called a bearish order block. Again, you can label this as, you know, weekly bear or weekly top, monthly top, weekly bottom, monthly bottom. And I want to drop down to the daily joint. Okay, when I drop down to the daily, guess what? The daily order block is in line, you know, maybe a little bit higher than my weekly joint. Oh, look, the top of the market is right there. Again, you can label this. I'm not. So this is a very simple analysis. This is a bearish order block. This is telling me that gold is going to drop, right? And the most likely target is right here. So this is what I expect to see from old gold next week. I expect price to go here. And I expect price to push down to this order block. Everybody understand that? Okay. If this is the first time that you saw this, probably looks a little weird to you, because I don't care about you know, support and resistance or whatnot, right? This is technically the order block, right? You guys follow me? This wick goes all the way down into this weekly order block. It's technically the order block. But price, I expect to push down back into this weekly order block. So this is not very, this is not so different, you know, than what you already know. Okay, if you understand market structure, right? Let me try to correlate this to your support and resistance. Most of us learn about higher highs and lower lows, right? If it makes higher highs, the market is going up. If it makes lower lows and lower highs, the market is going down. Okay, this is no different, right? We can visually see higher or lower highs, right? And lower lows. Well, actually, the lows are kind of flat right here, but the market is coming down. So the market was here. It broke structure. This is structure. It broke the body of this green candle. That's what this red candle did. It broke the body. It broke structure going lower. Anytime you see a break structure going lower, expect a retest. All right. Our entry is on this retest. And we're taking the trade lower, right? As a rule of thumb, for when you're trading smart money concepts, your first take profit is at the body of these lows, right? This is TP1. And you need to get whatever you risk out of this. So for instance, if you're risking 1%, then your TP1, you should take profit at least 1%. And then the market pushes down. Okay, let's talk about taking partials. And I don't want to insult anybody's intelligence, but for a long time, I thought that you had to have several positions open in order to take partials, but you don't. Let's say you're taking this gold trade and you're trading a 0.02, right? Your entry is at this red line, all right? Price hits the red line, you go in a little drawdown, then it pushes down, you're in profit, right? At this line, if you're 1%, if 1% of your trade is half, right? You're gonna go in and close your trade, you hit close trade, and instead of closing everything, you're gonna adjust that number. Instead of it saying 0.02, you're gonna adjust it to 0.01, close. And it'll close half of your trade. And the rest of your trade will just keep running, okay? If it's not half, if it was a larger number, like if you traded with a 0.20 and then you had to close a 0.08 for 1%, the rest of the trade, the 0.12 would continue to travel down to your take profit. Do you have any questions on that? Do you guys understand what I mean when I say frame a trade?
Yes.
Okay, so is this anybody's first time or their first introduction to smart money concepts? All right. All right. So there's a lot of people saying, yes, this is their first time. By you guys telling me that, then I'm going to go ahead and assume that you're just not asking questions because you're not comfortable. You don't know me. You don't know me. So I'm going to beat this order block thing up. And I want to.
Do you mind actually labeling just because it is our first time or my first time?
Yeah.
I know that you said that we should just label it, but I'd like just a visual concept of it initially. And then afterwards, I can always just go back to whatever I have, please.
Sure. Thank you. All right. I'm going to label. I'm going to go back to my monthly chart. And I'm going to talk about these things again. Okay. I'm going to hide my moving average. You don't need anything else on the chart. When I zoom out, you can visually see that gold has literally only been this high one other time, right? So this is the top of the market, even though there's no visual order block up here on the monthly. So I'm going to use a call out box. You can put monthly OB, monthly order block top, right? Or you can just put top of the market. This right here is my monthly OB, bottom of the market. Then I'll drop to the weekly. Weekly OB. Top. Oh, my nephew wrote that down. All right.
While you're doing your labeling, I just wanted to ask, are you starting off at the monthly time frame because you stay in the trades longer, or is there another reason why you're starting there as opposed to, say, starting at the daily?
Well, I start at the monthly because I want to understand the bigger picture. It's my opinion that everybody should start on the higher time frame. Even if you're trading a lower time frame, if you understand what's going on at the top of the market, you'll understand how to trade on the lower time frames, right?
Understood.
But I do take my trades on the daily. So really, I'm just 3 time frames up. Come here, Junior. All right, I can go to the daily now. Same thing. I'll use the call out box. I know a lot of people who just use a text box. This is a bearish order block, so you can put top or you can put bearish, you know, whatever, however you want to label it, right? And I'm going to use this order block. This is technically the order block. Okay, once you have these labeled, this gives you a better idea of where the market is going, right? So your trade is going to happen in this white area. Okay, your trade is not going to happen up here. Your trade is not going to happen down here. By picking out all these order blocks, you understand where your possibility to make money lies, right? This is the area that's available to you for money making. You don't have to worry about coming way down here or way up here. It's not going to happen. The money making will happen between these white areas. And this is why I call this framing the market. Everybody understand that?
Yes. Yes.
Okay. All right, let's talk price action, because price action and market structure, price action and market structure are still kings. So I'm glad you guys asked. I'm going to trash everything that I just drew. And I want to go to a pair. What do you guys trade? GU maybe? Let's do a non-war pair. All right. So this is a non-war pair. So really, I expect really I expect healthy price action. All right, what's healthy price action, guys? We just talked about healthy price action. If you take this chart and you look at it, way back in May of 2021, something happened and the Australian dollar dropped, right? It pulled back. Just for S and Gs, let's put a fib on this move, you know? I like using the fib. I'm gonna use it from this top to this bottom, right? The market came from this top, traded down to this low, right? Then it retraced, and where they hit the 50%, then it pushed down further. Push all the way down to this level. Then it retraced. Where is it at? The 50% of the golden zone. And I expect for it to push down a little bit. But let's talk price action. You guys remember a little bit earlier, we just talked about imbalances, right? This is an imbalance. Why is it an imbalance? As previously discussed, the wick of this green candle, the body of this red candle, we expect the wick of this next candle to meet this wick. That would mean that there was healthy price action. There was not in this case. When price came back up, it never touched the zone, pushed back down. Price comes back up to where you guys would call support. What the heezy is going to happen here, we don't know, right? But we understand that this is where the liquidity is, right? So before anything like this happens, you have to ask yourself, what do you expect to see first? Remember, this is a monthly chart. I'm not, anything or anybody special. But what I anticipate is to see this right here. You see how the price went up? I expect to see some wick action, folks. Is it going to come all the way down here? Probably not. But I'm going to use my fib on this one candle. Right? The Fibonacci tells me that my golden zone is right here. All right, while we're on the Fibonacci, let me not glaze over the fact that some of you guys don't even know what a Fibonacci is. Okay, a Fibonacci is a tool that measures retracement. Okay, why is that important? Okay, because anytime price moves, right? You have an impulse move. You have a pullback, right? Then you have another impulse move, you have a pullback. An impulse move and a pullback, which in this case turns into a reversal. So a Fibonacci, right? And the Fibonacci is located right here, guys. You have the crosshairs, you have the trend line, and then you have the Fibonacci, right? There's a guy on here named J Take Profits. YouTuber. He uses the Fibonacci. He has a video, right? Jay Take Profits Fibonacci. That video is the exact settings that I use to include the little colors of my golden zone. Okay, the golden zone is from the 50% retracement to the 62.8. That's the golden zone. Why is that important?
It's the 6-1, not 6-2.
Okay, I'm sorry, 61.8. Why is that important? If you understand smart money concepts, the banks do not participate in the market unless they can get it at a discounted rate. They can get price at a discounted rate. What's a discounted rate? At least a 50% pullback. I know that just went over some of you guys' heads, so let me slow down. If you want to sell, right? You're going to sell from this high down here. If I'm a bank, and I'm just going to use some fictitious figures. Let's say, you know, I call a market maker or whatever, and this is not how it really happens. But I just want to give you a basic understanding. Okay. Say, hey man, I want to sell. I want to put a sell order. I got $5 trillion. I want to sell AU from this point. The market maker is going to take my order, and then the market is going to start pushing down, right? Once the market gets here, I take profit on $2 trillion. What happens? The market goes up, right? So then I throw some more money in there. Hey, I'm going to sell it again. The market pushes down. I take profit. The market pulls back. You get it, right? Once I get here, I take a big chunk and I take a lot of profit. So the market shoots up. Once it shoots back up to this 50% rate, right? This is a 50% discount, guys, from where the market started. This is 50%. So even though I might have started with $5 trillion up here, now I might have $8 trillion, right? I might have closed out my order. The market came back. I throw $8 trillion right here, and it sells down. This one move might have taken it from 8 trillion to 16 trillion. Then I take a profit, and it comes back up. Then I jump back in and sell it again. Think of somebody doing this, right? And this is the market moving, right? So now I close my order completely, and maybe I buy it from this point, and the market starts pushing up, and I'm taking profit, right? I need to take profit now. Once I take profit, the price needs to push down. I can get back in for the buy and buy it back up. On a large scale, right? This will probably help you understand how this market is moving, okay? This Fibonacci tool allows us to measure the pullback, because I don't have any friends that put in $5 trillion orders. They don't ever come tell me. So I just kind of have to use this tool to see when I think that they might enter the market, right? And when price gets to this area, now my eyes and ears perk up, and I start watching for price to keep pushing up, right? The same way you kind of watch when price gets to this level to see if it's going to show signs of rejection and for it to push down. All right, so now that we covered this Fibonacci, hopefully you guys have a better understanding of why we even use a Fibonacci. Why is it called a Fibonacci? Because some clown named it that. Maybe his name was Fibonacci, I don't know. But it's a great tool. We use it a lot. My good friend Alicia, taught me some great uses, for the Fibonacci. All right, the name of the YouTube video. Jay Take Profits. Fibonacci. This is my brother's one of his favorites. In fact, I think he wants me to play this because he told me to play this for some of y'all anyway.
Extremely greedy.
We're just gonna listen to the first few minutes because this is his favorite.
I remember about a year ago, I was extremely greedy. I wanted to get rich quick. I was taking Lambo lot sizes, over leveraging my account, trying to get rich very fast. And the markets humbled me very fast. The markets humbled me. And until I got tired of losing money, until I got tired of spinning my wheels, constantly losing, winning, losing more than I win, and I finally gave in to the plan and the proper process of compounding my account, that's when I took off. And I can sit here and tell you guys today that I'm about 75, 80, maybe 85 on some months discipline. I stick to my plan. I'm not super anxious to put a trade in. I enjoy what I do, and I also enjoy being patient. And when my mentor taught me how to use the Fibonacci, it was game over. It was the blueprint that I needed. It gave me a blueprint of the market. It showed me how the market moves. And it's always going to test that golden ratio. And I'm going to reveal that to you today. I'm going to show you everything is based on Fibonacci. And if you want to learn how to use that, and so you can always know where you're at in the market, then stay tuned. You know I'm going to lace you up properly. Let's get it.
All righty. So that's the video you need to get your settings from. I don't agree with everything that Jay is spewing in that video. I don't believe the Fibonacci controls the market. I don't believe he believes that either. But I think at the time he was just happy that that tool brought some accuracy to his trading. So I think it will help bring accuracy to ours as well. I know it really, when I started using the fib, it really made sense. So I think it's a good bet that we can anticipate AU pushing to the downside, right? I think the fundamentals also support the fact that AU should start pushing to the downside, especially if our economy continues to show promising numbers. You know, we just got finished with the crazy week of trading, NFP week. The economy was in good shape, right? We just raised interest rates. All those things would benefit the dollar getting stronger and the AU pushing to the downside. So that's going to support this retracement, right? And even if everything was crappy for the dollar, the price is not just going to go one direction. You need pullbacks, okay? So we're going to look for price to start pushing down in AU, maybe to hit our zone, and then we'll look for a price to push back up. Even if it doesn't come all the way down, it could come you know, just a good portion of the way down, and you're going to make money just by understanding how the market moves. This is about 140 pip move if it moves all the way to the golden zone. You only have these opportunities once a month, right? Because the candle on a monthly calendar is going to close once, right? Just at the end of the month. And luckily for all of us, it just closed. You know, the new month is starting. This is what we should see first. Or, right? Or it'll push up first and then it'll push down because it's just going to change directions. Either way, we're right where we need to be. We're available for these types of trades, okay? And we do the same thing on the weekly candles, right? On the weekly charts. You can do the same thing on the daily charts. The market is fractal. It does this on every time frame, on every level, every day, every time a candle closes. So it doesn't matter what time frame you're on or what you're trading. It's the same. It's the same. If you want healthy price action, those wicks are going to have to line up. You're going to have to get some wick play, right? And anytime you get an imbalance, the market is going to trade back up or trade back down to mitigate that imbalance. If you see this imbalance right here, the market eventually trades back down, closes out this imbalance. It trades all the way down here, closes out imbalances in this order block. So at some point, even if the market comes and taps in, I expect for it to at least come up and mitigate this imbalance at some point. This is a monthly candle, so it's going to take time for these types of moves and types of trades to play out. What takes less time is what you see on the weekly candles, right? Isn't this funny that where we have the price pulling back to is right at a weekly order block, right? An order block that has not been mitigated. Now, if we had taken this trade last week, right? I don't know if anybody B Chase or anybody who trades with me, AT. Hey, Aaron. I don't know that. I know I didn't take this trade, so it's kind of weird. If you had spotted this trade last weekend, you'd have drawn this order block. AT, you on the call?
Yeah.
Did you look at this trade last week?
What is gold?
No,
Nah.
this is AU. AU,
Oh,
son.
it just switched. Oh, it just switched. Yeah, no. AU.
Last
Let me
week.
look. I don't think so. If it was a daily order block one of them days, we
This
did.
is not daily. This is weekly. You would have saw this last Sunday.
Oh.
I was on the,
Yeah, I think we did.
did we? I don't remember calling out AU. I remember another taking a weekly, a different trade. But if
We did do it.
well, I didn't hold it all week. I
don't think nobody.
I think I was in AC. All right, you can mute. But if you had taken this trade last week, this is 156 pips. All you would have had to do is put a buy limit in right at the top of this order block. And some point last week, without you even looking, price would have ding, tapped you in, and it would have paid you out 156 pips without you doing anything. You could have went to work, you could have went to school, you could have did whatever it is that you was doing in life, you could have done it. And all that would have cost you was a little time on Saturday or Sunday to see this order block last week. You'd have gotten paid, right? That's the beauty of swing trading, right? And then all you would have had to do is enter that trade, and it wouldn't have hindered anything else that you did. So, yesterday was the first day of April, and you see price started pushing down, right? It didn't quite push down far enough, but I anticipate that price could push right into this imbalance before pushing back down. We'll see how it actually plays out. All right, now I can drop down to the daily. All right, you retail traders call this a double top. The J Take Profits video is called Fibonacci, F-I-B-O, and you'll find it. Alicia Renee should know because she's the one that showed everybody else how to use it. She showed us all how to use it. But anyhow, this is a double top for if you trade Ruby's methods. You trade like I trade. Alicia, can you make sure you check those numbers on the PowerPoint that you post? Because
Yeah, Dad, I got you.
all right, this is a bearish order block. You got to tap in, so price is more than likely going to fall to this order block again. If you frame this out, you frame this up, this is where your trade is going to take place. You got 87.6 pips right here. As long as this order block is respected, your trade here.
I thought you were supposed to be labeling it, Teach.
Well, I did label it when I was actually showing it. Does that make sense? Monthly retrace POI using the fib, golden zone. Anytime you see GZ, we mean golden zone. The golden zone is the 50 to the 61.8. All right. I fibbed this one candle to get my point of interest. Then when I drop down to the weekly, lo and behold, this golden zone is actually at this weekly order block, which is confluence. I'm not going to clutter the chart, but this is really prices in this weekly order block. This is the top weekly order block. So your chart is labeled. When you drop down to the daily, there's a daily order block. Trade is already tapped in. So all we're waiting on is for the price to come down here. Any questions on that? Anyone? Bueller? I don't expect that you guys will understand all of this right away, right? But what I do ask is that you rewatch these videos. Go through when you back test, draw boxes around your order blocks, right? And when you draw these boxes around your order block, this is a bearish order block, all right? You got this green candle, last up candle before the down move. The down move breaks structure, which means it breaks the body of that green candle. See that red candle breaks the body? The key thing that we want to watch for is this next candle. We want the wick to come up and tap us into the trade. That's what I call a tap in, right? The wick comes up, wicks us into the trade, and the market falls. In this case, the wick did not come up to wick us into the trade, right? So it's not our trade. You don't worry about it. That's a trade that we missed, or the trade we didn't get involved in, right? You follow the market. Here's a doji, still an order block. Just use it from wick to wick. I think this, we still didn't get into this trade. Market fell. We missed all these pips on the daily, right? Don't worry about it. It's gonna be trades that you're not gonna be a part of. That's the part about being patient, right? Market starts coming up, and now you're looking for buy trades on the same side, right? You're just waiting. You're waiting to frame an order block in the. Let me just frame this one to show you when the trade actually does happen. Okay, this red doji, green candle breaks the body, going to the top side. This very next candle, see the wick taps you in, you're in the buy, right? You don't have to get out of this trade until it gets way up here to that order block up there. So basically, you would have taken this trade from here. You could have taken this trade from here to here successfully, right? There's the top. Remember smart money concepts. You're always looking at the structure on this side. So once it taps you in, TP1 would have been right here, this structure. The next structure is here for TP2, and then here for TP3. You would have, in this case, you would have made all those TPs, right? And then the market falls back down, right back into the order block and goes back up. So I don't expect you guys who are just learning this to see all these trade setups, right? Or to actually understand them at this point. But it's really that simple, you know. If you do your analysis on the higher time frames, and this is all that it is to doing analysis, is finding your order blocks on a higher time frame. Price is going to move, you know, between those order blocks. It might bounce on those order blocks or in between those order blocks several times, you know, which you guys call consolidating. I'll call it, you know, Wyckoff accumulation or distribution, but it might bounce there, you know, for a little while. It might bounce between those time frames. If you're trading in the lower time frame order blocks, you can catch those bounces, right? It's nothing wrong with you know, with catching or taking advantage of those moves. But once you have and understand these concepts, then your trades make more sense. You're not guessing direction, right? It's either coming from this bearish order block, going to find the next bullish order block, or is going from a bullish order block to a bearish order block, right? It's going to fill an imbalance. You know, there are concepts out there, you know, that if you understand how to trade, you know, that you'll be able to take advantage of. And here's what I mean. AT, my son should know exactly what this is. What's happening here, Aaron?
Hold on, I'm waiting on the screen. We on AU still on the weekly?
This is a daily.
That's what I'm saying. My screen going slow. You said
Okay.
what's happening here?
Yeah.
We're at the bottom.
Yep.
It's just coming. It came back. First coming back down to grab all that liquidity down
Okay. That's what I wanted you to say. This is a liquidity grab.
there. Yeah, liquidity grab.
All right. You can mute because your phone is terrible. Yeah, you must be in the car. All right. So if you understand, and you know, once you get in to ICT, this daily chart, man, will pay you. All right. So anytime you have a swing low, you know, a swing low, you have a low. Oh, I don't want to do it in arrays. Let me switch up, guys. Anytime you have this swing low, you have a low here or a swing high, guys. This works with swing highs and swing lows. Right? You have a low, a lower low, then a higher low. This is a protected low, right? So whenever you see this, you don't expect anything to come down here and violate this low. So this next, when this market pulls back, you know it's not going to go below. It's not going to go in here and destroy this low. This is a protected low. We should be looking for longs, right? We should be looking for longs at this point. So the market goes up. Now it comes down and it wicks past this protected low. All right. Anytime you see the market wicking past that protected low, get ready to make that money. What happens? You get about a 500 pip run, right? This is a liquidity grab. It's a stop run. It's a stop run on a low. Anytime you sit on a daily chart, you're gonna get paid. Now, war pairs, it may or may not happen, right? But I'm talking about a normal market environment. If you get a wick, you know, past a swing high or swing low, you can go ahead and expect the market to run the opposite direction. Okay, and in this case, it was just at a wick. If you can see this stuff on a daily chart, you'll get paid. There are thousands and thousands, you know, of traders who don't trade these higher time frames. ICT is one of them. He doesn't trade the daily, but damn it, he uses it. All right. Don't be a fool. All right. Use the tools because people swear by these dailies, man. If you look at the daily and you see that, I mean, why would you want to miss this meteoric rise? Why would you just want to trade from here to here when the understanding is the market is shooting up? Okay, so a lot of these things that I'm telling you, you're going to forget, but over time, you'll start coming back to some of these concepts and you'll start recognizing some of these concepts. It's only going to take once for you to miss a trade like this, and everybody else in the group is talking about it. The next time you'll be hip to the game. Okay, so that works on whether it's liquidity grabs, you know, stop hunt lows or stop hunt highs, right? It works both directions. So just understand that if you're, you know, blessed enough to see it, I don't know, we've caught so many of these things this year. You know, they just run right up. Look for these around times where interest rates are raised or around times where you know, you got the monthly financials coming out. You know, you'll get liquidity grabs. There are times of days, you know, that you're going to get turnarounds. You know, we call them Judas swings. The market goes one direction, you think you're good, you go to sleep at 2 in the morning, and then it changes directions on you. That happens, you know, it happens a lot. That's how the money is made. So all of these things as we, come together as a community, and as we start recognizing, we can take advantage of these moves. And these aren't my concepts. These concepts came from others. Most, I guess more so from ICT or Michael Huddleston than the rest of the guys. But there are several different styles of trading that I've been able to employ in my trading journey because I understood the basic concepts. You won't catch me on the 4-hour chart very often, and I know that's probably a shock, you guys coming from old lavish life, and that's where Ruby made a killing. But to me, the consistency wasn't where, I would have liked for it to be. And, that's not a knock on Ruby, it's, I didn't get the understanding that I needed, from Ruby's courses. But now that I trade these higher timeframes, I can pick the moves out, a lot more easily. A lot more easily than I could, during that guessing that was going on when I was in LLA. Do I have any questions over anything that we covered? So knowing, or after discussing what we just discussed, right? We discussed imbalances, we discussed yeah, I know you have to rewatch it. We discussed order blocks. We discussed Wyckoff. When I dropped to this 4-hour chart, do y'all see the Wyckoff playing out? Do you see the distribution playing out, right? The manipulation of these highs, right? For all intents and purposes, it's done, man. The market is done right here. Anything that happens after this is manipulation to get you out of selling this, right? I'll talk about war pairs in a minute, but anything that's done at this point is to get you out of selling this, right? So this market is about to start pushing down. And once it starts pushing down, your entry is going to come from somewhere around this level, right? It'll have you an order block or something that's going to come from this level. This will let you know when it pushes down. But isn't it ironic that if you trade order blocks from the higher time frame, that you would be in the trade right here going down? This red line would have been your entry for a sell, right? And this green candle, it went up, tapped you right in. This would have been your entry for the sell. If you just trade Wyckoff, this wouldn't have been your entry. You would wait until it gets to about right here. It'll be another order block, and then it'll push down. So here's the difference. Order blocks and imbalances are not the same thing. But here's the difference. The stop loss area that you have to protect on a higher time frame is a lot more. And this is a 30.7 pip stop loss. It's a lot more than what you're going to get on a lower time frame, but I would encourage you not to worry, so much about what you have to protect just to get yourself in the trade. There will be ample opportunity you can add to your position while you're in the trade. Order block versus imbalance. An order block is simply this last up candle before this down move that breaks structure, right? Here's the structure. This red candle breaks structure to the downside. That's an order block. An imbalance deals with price action on a 3-candle series. We want to look at these last 3 candles, this doji, this long green one, and this green one before. In this 3-candle series, because price moves so fast to the upside, it leaves an imbalance. Right there. All right. This green candle leaves a wick to the upside. The bodies start equally, so this green candle pushes up and it leaves a wick. This 3rd candle needs to push down to this level in order for it to be healthy price action. Does everybody understand that concept?
Yes.
Who asked if order blocks and imbalances were the same? Let me see. No, you're not tripping. Listen, I don't want anybody to feel bad about not understanding this. This is part of trading. That's why we're here, right? None of us have the ultimate understanding, right? But we can learn additional things, additional nuances from each other. I don't want you guys to think by any means that I'm some master trader. It's just not, that's not the case. I just told you, Alicia showed me something with a fib that I was unaware of, right? I didn't use it that way. If it wasn't for Alicia, then my success rate would not be where it is now, because I understand how to use a fib. I just didn't use it the way that she showed me how to use it. So don't feel like you should know this or you should understand. You should have an ultimate understanding of this. What I'm showing you, you may have never used this before. Most people never use a weekly chart. Most people will never even look at a weekly chart. And here I am looking at monthly, weekly, and daily. It's just an added resource for you guys, right? Yeah, war pairs. War pairs are pairs that are over in Europe, right? And affected directly by the European war. The euro, the British pound are 2 main currencies. You can't even trade the Russian ruble right now. If you look at the Russian ruble, the spread is like 52,000. Like you can't trade it. It's so ruined, or it's so in flux by the war. But the war has greatly influenced the movement of the euro and the British pound. So much so that a lot of the other fundamentals aren't playing out, when it comes to trading those pairs. Okay, Monk, let's talk about you trying to see the way I box out order blocks. Okay. Woo. Cha. Woo, cha. All right. So order block, just to avoid any confusion, an order block is 2 candles. Don't laugh, Buck. I'm just being silly. So let me get rid of the rest of this stuff. Get rid of these drawings and crap. Let's just talk about these 2 candles. All right, this last red candle before this green candle that breaks structure. This red candle is my order block, right? Hang on, iPad. I don't know who you are, iPad, but let me get with Monk real fast. Okay. So if you look at these two candles, I would call this a bullish order block, and I would say, hey man, the market is going up, right? Based on this red candle, the green candle broke structure to the upside. So the way I box it out is this way. But because we have all these new people, what I'm going to do is extend my box to cover the entire red candle, wicks included. You got that, Monk? See how that my box covers this entire red candle? Okay, this is the important piece. This is the important piece when you start trading order blocks. It's important that we know that our trade is going to take place because we expect this market to go up. This is where our trade is going to take place. This is my entry, right? And I know we've all been taught to drop down, time frame. I got it, y'all. I got it, right? If you want to drop down and you're comfortable dropping down, by all means, drop down. You can get you a greater entry and all that good stuff, right? But what I'm trying to tell you, and what I would love to explain to you is, you don't have to do all that, okay? What you can do right now, this candle closes. This candle is closed. You can go in your phone right now while you're at work, while you're in the bathroom, whatever. You can say, hey, buy, buy limit at this price level, stop loss at this price level. That's a 21.7 pip stop loss. This is one to 171. When you trade smart money, a 1-to-1 is good. But this could be your trade, right? This could be your trade setup. This could be your trade setup. That would be considered a good trade. Wow, you're a winner. Congratulations. You won. Now, if you're trading this on the 4-hour, you had to take this 1 to 171. And this is the importance of framing your market, because if you're trading on a higher time frame, or you're using the higher time frame charts, then your bias may have already been to take the damn trade to the next order block, right? And maybe you would have won your little money instead of playing with this bull crap on the 4-hour. I'm just saying, y'all, like, I'm not knocking anybody's trading stuff. And I want you guys to find your success on whatever level you find your success on. But what I want you to do is open your noggin to there being some difference, right? There being different ways to play this game. So if you frame your market and you use those higher time frames, it gives you parameters, right, to play in, right? And it allows you to extend maybe beyond what you're comfortable with. You go from a 1.17, which is still a good trade, y'all. Still a good trade. If you're risking 1%, you made almost 2%, almost double. That's cool. But in this scenario, you're risking 1%, you made 4.3%, which is a little bit better. The point is this, right? All we need as traders is to have some sort of advantage over the market, right? And what our advantage is as a trader is that once we see this order block, right? And I'm just not comfortable on the 4-hour, guys. Like, if I see the order block on a daily, then I'm super confident, right, that the daily order block will be respected, right? Especially if I look at the weekly order block, and the weekly order block is saying bullish, right? This is my weekly order block. Oh, I told you I was going to use the wicks. The people who trade with me know I don't really mess with these wicks. But just because it's new people in here, I got to be consistent. But because there is a bullish daily order block, and this weekly order block is bullish, man, I might put 5% on this. I do 1%, guys, but it gives you extra confidence that that things are, it's confluence, right? You have 5 and 6 different things that are telling you that this is going up, right? You got a golden cross to the upside if you guys use moving averages. Whatever, everything in this trade, everything about this trade is telling you that you're going to win to the upside. So this is called confluence. It allows you to be successful. It allows you to have a degree of success on your trade. So if you take, I'm a proponent, the way I like to do it, I like to take 2 trades at a time. If you win 4 trades a week, chances are you're probably going to win at least 10% that week. It's just the math, right? If I take 4 trades and I win 4 trades, this is a 4% win right here, right? I can take this trade, and if I get another one, this a 4%, that's 8%. So I only got to win 3 trades this week to make my 10%. 10% a week will make you pretty rich, right? And I'm not a proponent, I'm not telling you that you're going to get rich trading. You can get rich if you're consistent. You damn sure will be rich, right? Eventually. I'm not saying you'll be rich next week, but I'm telling you, right? I'm telling you that you're going to make more from trading than you can make at your job. And that's just how it works. It's not anything that's magical, or it's not anything that I'm doing that's jaw jacking, or that's crazy. I'm just trading what the charts are showing me, and I put the trade in every freaking time, right? You put the trade in every time. You should trade like a robot, right? And I'm not telling you to be in the market every day of the week. You don't have to. Pick you out 3 or 4 trades, hop in those trades, let them do you. I mean, if you lose 2 trades, chill. Next week will be here, right? Don't blow your account this week because you want to be in every trade. Pick you out 2 trades, right? You get those results. If you win those 2 trades, get in 2 more, right? You can get in trades on Sundays, Sunday going into Monday. If you win those 2 trades, you can get in trades Wednesday going into Thursday, and you'll eat. Trust me, you will eat. You make more money than you can spend. You can make 5-10 grand a week. And it's nothing. You don't need a $200,000 account. You can have a 50K account. You can have a 20K account. You can have a 10K. You can have a 2K, right? A 2K account, you're not going to make a crap load of money, but you make 10%. The next week, it'll be a 4K account. Then the second week, if you make 10%, you have a 6K account, and you can just keep scaling that thing up, and you just keep growing. Do you have any questions over anything that we've covered?
Hey there, I have a question. So currently, right where price is on the daily, so you have and then because you drew the zone from the left,
Right.
from that order block, when you had that first order block, that first drop, or bearish engulfing, as you know, as we learned it. Yes, the first one. Would you have drawn that order block and immediately put in for a sell, or would you have been waiting for something else?
Well, that's an excellent question. So let's talk about this for a minute. Now I want to zoom in so nobody's confused. This is an order block. How long is this order block good for? Until price invalidates it by going higher, right? So if you look very closely, this green wick violates that order block, so we can delete it, right? Directly after, you get a liquidity grab and price shoots down, which gives you your new order block. So you could have put in a trade right here, right? You'd have been in drawdown. It gives you what? Another order block inside this order block. You don't even have to mark it out, but you're still in this trade. You'd have been in drawdown for a minute. You'd have went in a little profit. You went back in drawdown. Now you're right here in a little profit. Still with this position, understanding that the market is going to push down, right? The thing you have to suffer through or understand as a swing trader is you don't control the time, right? You understand the direction, but you don't control the time that it's going to take for the trade to push in your direction. If I had taken this trade right here and it had pushed down, as soon as it had wicked up, I'd have got out. That's just me, right? It gave me another bearish order block. It would have pushed down, and I would have been frustrated. I would have had to close out anyway because I trade funded account. I can't hold it over the weekend, but I would have had to close out. I'd have been in a little profit maybe, or maybe not. Maybe, well, if I had used this order block, I would be maybe in a couple pips profit. It would have been a frustrating.
Would you have gotten out, or would you have gone down to a 4-hour or 1-hour time frame to find the next order block? No,
I never go down. I don't go to the, I don't use it.
Okay.
And that's just me. Like you can drop down. There's nothing wrong with dropping down. The problem, here's the problem with dropping down for most people though. Most people cannot correlate time frames. Most people bungle it up, right? If you are a person who can correlate time frames, by all means drop down, right? You can drop down to the 15-minute, the 5-minute. But if you make a mistake with your time frame, you're going to jam yourself up. You'll get caught in a retracement or whatever. But there's nothing wrong with dropping down. I never drop down. I don't really have to. Like, if I get into a trade on a Thursday, knowing that I have to close on Friday, I take my profit or my loss.
Gotcha. Gotcha.
Most of the time I'm in good shape, by Friday anyway. Any other questions?
Hi, I came in a little late, so I don't know if you already showed it, but I just wanted to know if you can show an example of a bearish order block and a bullish order block. So I know you already did the bullish one, but can you show like a bearish one for me, please?
Okay, it's right here. Bearish or OB, bearish OB, right? What does a bearish order block mean? The green candle, the red candle that breaks structure to the bottom side. What do I mean by structure? It breaks the body of the green candle going down. This is a bearish order block. You got the green candle going up, the red candle breaks structure to the bottom going down. The next candle, the market taps you in. and it sells off.
Okay. Gotcha. So is it best to look like at a higher time frame
You have
for
to.
the order blocks? Yeah.
Well,
Okay.
let's talk about this. Let's just say you felt like the daily time frame was high enough. I don't need to look at any other time frame.
Hmm.
So if you're just a trader who say, okay, I'm gonna use a daily and the 4 hour,
Mhm.
and you see this bearish order block, and you just throw your sell order in, right? You can put a
Mhm.
sell limit because you know you expect price to push up, tap you in, and sell, right? That's what bearish order blocks mean.
Okay.
You lost the trade. You see that?
Yeah.
Because the higher time frame, if you had looked at the weekly, it was not telling you to sell, right?
Right.
So you have to understand where price is, and this is where the benefit of framing the market comes in, right? If you frame your market,
Mhm.
you'll understand, you know, where you need to put your trades and what direction you need to put them in. And also, you know, we don't know, you know, it's one bad thing about back testing is you don't have the news, or you don't know the underlying fundamentals of the market that were in play at that time, right?
Right.
Back testing tells you what the candles did, but it doesn't give you the fundamental reason behind the move. So like if we didn't know about this war in Europe, we just looked at the euro or the British pound, we would get a false representation of what's actually going on, because the war greatly influences the way those pairs are moving. And we can't just discount that, you know, when we look and we try to back test. So back testing is cool, but I would just encourage you to take back testing with a grain of salt, right? It's not the be all end all, but you know, it does serve a purpose. And you know, I think if you go and you look at the things that I show you today, you would have won a lot more trades than you would have lost, right? There is no trading scenario or system that will allow you to be 100% successful. But you can execute these trades, you know, probably in the 80s, you know, as far as being successful. And, you know, you're just not going to have the losing weeks. It's just not going to happen.
Okay.
So I have a question really quick. Sorry. So that order block that losing order block that you just did, even on the daily, because it is currently in an uptrend.
You shouldn't take the bearish order blocks.
Not saying that we shouldn't take the bearish order blocks, but were we at a, you're saying are you saying we shouldn't? Are you're asking me that? Or are you saying no?
Why would you, right? Like if
Right. No, that's what I'm saying.
You should trade with the trend.
Yeah.
That's, you know, like market structure, it's still going to be king, right? But you know, once you understand order blocks, it's just going to help you refine where you should enter the market. Like Ray Charles can the upswing, right? And you know, my good friend Alicia is good with drawing bull crap like this and putting BOS on it, right? And I know this is a daily chart, but you know, if this is no different than this being a 15-minute, a 1 hour, a 30-minute, 4 hour, right? It's clearly an uptrend, and it's clearly a break of structure, you know, and I know a lot of people, I say clearly, a lot of people won't see this as a break of structure, but you know, don't let the chart fool you. You have a double bottom, right?
Mm-hmm.
Price is pushing up. You got higher lows and higher highs being made. Why would you take this? Why would you take a sell?
Because it's in the middle of the peak high and the peak low.
Uh,
No, I'm saying I wouldn't have taken a sell.
yeah.
I'm
Well,
just saying,
hopefully nobody would. You know, I mean, but here there's reason to take the sell because you broke structure, right? There's nothing wrong with taking the sell. But where are you going to take the sale to?
mm-hmm.
Right? That's when I would fib the entire move.
Right. Okay. Gotcha.
It would give me a golden zone that I could take this because we broke structure. It's going to sell to the golden zone. Right?
Mm-hmm.
Like, I'm not Houdini. I can't make this up. Like, this is just my understanding of how the market moves. We broke structure. We can sell this to the 50, right? I would have been comfortable selling it to the 50. I wouldn't have been comfortable holding it to the 61.8 because this is an uptrend. I'm just telling you how I think about the market. There's reason to take it after a break of structure. There's no reason to take this just because you see order block on a daily, right? That this is how
right.
you do up. You still, I mean, the basics still apply, right? Like market structure is still king. An order block is just going to clean it up for you. You don't have to worry about support and resistance. You have to worry about I'm taking this order block from here to the next order block, right? And maybe you can see the overall move. But this, if you understand market structure at the very basic level, then you can clean up, you know, you can clean up with these trades. Hopefully that answered your question about taking the sale.
Yep.
Okay. Hey, Alicia, I'm just saying, you know, I mean, you know, it's all good. I love and appreciate you, Alicia. You know, I was doing okay, you know, but the Fibonacci really cleaned it up. Do I have any other questions? You know, with the amount of folks that we have in the chat, it will probably be beneficial to break up, you know, these sessions and these days, right? With that being said, you know, I don't have enough voice to speak to everybody every day, right? I'm always available for anybody who needs help. You guys reach out, I'll help you the best I can. The only thing that I ask is that you put your bias to the side for a minute while I'm teaching you, and I can show you what I know. You know, what I know may not be comfortable for you at first, but what I can tell you is that it 100% works, right? And I'm a risk 1% type guy. I'm not, I mean, I love to gamble, but I just save my gambling for Vegas. I trade a funded account. So, you know, I can't afford to risk 5–10%, right? I can only have 5% drawdown. Those are the rules. So I have to trade with a 1% risk every time, because if you don't trade with a 1% risk every time, if you start upping that risk, then you have to be correct about your trade 100% of the time. And I just don't know anybody who's been correct 100% of the time. I love guys like Anthony Williams. Love me some Q Banks. I don't trade like them. I love Charlene FX. I don't trade like them because I don't have a personal account like that. You know, I trade a funded account, and you know, they can trade and lose heavy. They can lose $100,000. You know, if I go into 5% drawdown, then it's like me losing my job, you know, because, you know, I get paid from that the same way you get paid when you go to work. If you're interested in being a funded trader, I can help you out with that too. You know, we got Will Ross, who trades indices successfully. It's a little unorthodox for my trading style, but damn it, it works, right? I'm a proponent of people who are successful when it comes to trading. I'm going to give you a quick overview of how you can trade these order blocks on a lower time frame. And this Brianna is going to actually launch this, and she's going to do this on a daily basis on some day and time that I don't know. Just going to give you the concept. Oh, I think this is going to be too close. Okay, so the thought process behind the order block concept that she's going to show people. Whenever I trade order blocks, I generally speaking, I don't worry about the wicks. I like the bodies, right? So if this wick doesn't come down to the body, I won't be in the trade. Now this is a doji, so it's a little bit different, but just the thought, just keep the thought in mind. So what she's going to do is she's going to take these order blocks, right, that break structure to the top side. When they come back, she's going to enter the trade and take it up, right? And the thought process behind it on these lower time frames is the order block that causes the break obstruction can always be traded back up. Does that make sense? Now I know this is a daily chart, but we're going to do this on the 15-minute chart. And she's going to take the order blocks that break on the hour.
Isn't it just a break and retest?
Exactly what it is. So if you do this on the hour, right? If you have this breaker structure, the thought process is when price comes back, it's going to tap into the order block. You can trade it back up to the top to equal highs, basically. And what it would do is it'll give you a larger win rate based on what you have to protect as far as the stop loss. Does that make sense? I don't want to steal her thunder. So I'm not gonna break it down and show you, you know, any further, but I know it works. I know several people who trade like that. I just don't have the time or patience to be on these lower time frames trading like that. I have any other questions? Okay, so I don't know, it's been about 2 hours, I think. I would like to have this meeting down to the 1 hour mark. We used to always get it accomplished in an hour, but we've taken on more people. But in an effort to do that, you know, I'm going to have to break up the meeting, right? So I'll just do the regular meeting, and then maybe we'll do a smart money concepts meeting on Sunday, you know, and that way the new people can learn, you know, about the order blocks, imbalances, Wyckoff, you know, all that good stuff at a separate time frame than the people who've already been through that. Okay. Again, if you guys need anything, you know, please feel free to hit up one of the admins. You know, let the admins know that you appreciate them. You know, they work their butts off. None of us are getting paid. I really appreciate them, you know, admins, you know, I appreciate all of you guys. Thank you for what you do. Thank you guys for making this a successful community. And, you know, when you're out in the chats, please play nice, man. We've only had to get rid of a couple people. You know, just be adults, put your comments in the appropriate section. Don't attack people, you know, all that good stuff. But that's all I have for you guys today. I appreciate you guys for hanging out with me. If you guys need anything, hit me up in the chat. Go like my Instagram page, please. The IC4X clearly page. Eventually, I'll have enough likes so they can pay me my money. And I'll do the same to you guys. I'll follow you guys on Instagram and all that good stuff. Until next time, y'all be safe. Tomorrow morning, same time, for the people who swing trade, we'll be here at 11 o'clock breaking down the pairs. All right, y'all have a good one.
Hold on, Todd.
Thank you,
Thank you.
Todd.
You said, hold on, Effie? You guys.
Yes, I was just wondering because now you said are you going to do this every Sunday, 11 for the swingers?
So yeah, for swing traders, we meet at 11. We meet Monday through Thursday at 5 p.m. But on Sunday morning, we meet at the same time. We don't meet Friday because there's no need to meet on Friday. We can just look at it Sunday.
Sunday, 11 a.m. for your time, which is
East Coast time. I'm actually in Texas, so it's 10 my time. But yeah, 11 East Coast time.
every Sunday. Okay, tomorrow. Thank you.
Yes, ma'am.
All right, see you tomorrow. And thank you, everybody. Bye.
Hey, Shay.
Yes.
We didn't break down gold today, huh?
Todd, don't start.
Ready?
Don't start.
Did you have your